You think the max you can put into a retirement account is $23,000? That's cute. I just shoved $46,000 after-tax dollars into my Roth IRA, and the IRS can't touch a single penny of it. No penalty, no tax bill, no questions asked. Sounds illegal, right? It's not. It's called the Mega Backdoor Roth, and if you're not using it, you're leaving literally hundreds of thousands of dollars in tax-free growth on the table. But here's the thing, 95% of financial advisors won't tell you about this, not because it's complicated, because if you know about it, you stop needing them. Today, I'm going to break down exactly how this works, step by step. We're talking about the single most powerful retirement loophole in the American tax code. And by the end of this video, you're going to know whether you can use it and exactly how to pull it off without getting destroyed by the IRS. Let's get into it. Here's the problem most high earners face. You're making good money. Maybe you're in tech, finance, consulting, or you run your own business. You're maxing out your 401k. That's $24,500 for 2026. You're also maxing out your Roth IRA. That's $7,500 for 2026. And you still have cash sitting in a taxable brokerage account, getting hammered by taxes every single year. Dividends? Taxed. Capital gains? Taxed. Interest? Taxed. Every dollar you make in that account, the government takes a cut. Now, if you're a high earner, and by that I mean over $168,000 as an individual or $252,000 as a married couple, you can't even contribute directly to a Roth IRA. The IRS literally says, sorry, you make too much money. No tax-free growth for you. So you're stuck. You've got three options. Option 1, keep dumping money into a taxable account and watch the government eat your returns. Option 2, put more into your 401k, but you're already maxed out at $24,500 for 2026. Option 3, nothing. Just accept that you're going to pay taxes forever. But here's what the IRS doesn't want you to know. There's a third bucket inside your 401k that HR never mentions, and that bucket changes everything. Every 401k operates under two separate IRS limits. The first limit is the employee deferral limit. That's the $24,500 you already know about. That's the money you can put in as pre-tax or Roth contributions from your paycheck. The second limit is the total annual addition limit, set under IRS Code Section 415C. For 2026, that limit is $72,000, and this is where it gets interesting. The $72,000 limit includes three things. Number 1, your employee deferrals, that's the $24,500. Number 2, your employer's match or profit-sharing contributions. Number 3, a third category called after-tax contributions, not Roth contributions, after-tax contributions. There's a difference, and it matters. Most people don't even know this third category exists because HR never talks about it. But if your 401k plan allows after-tax contributions, you can fill that gap between the $24,500 deferral limit and the $72,000 total limit with after-tax dollars. Let me give you a real example. Say you're under 50 years old. You contribute the max $24,500 to your 401k. Your employer matches $10,000. That's $34,500 total. The total limit is $72,000, so you have $37,500 of available space. You can contribute that $37,500 as after-tax dollars into your 401k. Now here's the magic, and this is where the mega backdoor part comes in. Once those after-tax dollars are in your 401k, you convert them to Roth. You can do this in one of two ways. Option A, an in-plan Roth conversion. That means converting the money inside your 401k to a Roth 401k. Option B, an in-service rollover to a Roth IRA. You move the money out of your 401k and into your personal Roth IRA. Either way, the result is the same. That $37,500 is now in a Roth account. It grows completely tax-free. And qualified withdrawals in retirement? Also tax-free. Now let's talk about the numbers for a second, because this is where people's jaws drop. The standard Roth IRA limit is $7,500. With the Mega Backdoor Roth, you can move $30,000 to $40,000 or even more into Roth accounts every single year. Over a decade, that's $300,000 to $400,000 of tax-free growth. Over 2 decades, we're talking nearly $1 million. And remember, if you're over 50, you can contribute even more because the catch-up contributions apply. But here's the catch, and it's a big one. Your 401k plan has to allow 2 specific things. Number 1, after-tax contributions. Number 2, either in-plan Roth conversions or in-service rollovers. If your plan doesn't allow both, the strategy won't work. And here's the reality. Only about 25% of plans actually offer both features. But if you work at a large employer, especially in tech or finance, there's a much higher chance your plan has this. So step 1, call your 401k provider and ask 2 questions. Question 1, does my plan allow after-tax contributions? Question 2, does my plan allow in-plan Roth conversions or in-service rollovers? If the answer to both is yes, you're in business. Now, before you get too excited, I need to warn you about something. There's a trap, and this trap has cost people tens of thousands of dollars in unnecessary taxes. It's called the Pro-Rata Rule. Here's how it works. The Pro-Rata Rule says that when you convert after-tax money to Roth, the IRS looks at all your IRA accounts combined, not just the account you're converting from. Every single traditional IRA, SEP IRA, and simple IRA you have. And if you have pre-tax money in any of those accounts, a portion of your conversion becomes taxable. Let me give you an example so you understand how painful this can be. Say you have $100,000 in a traditional IRA from an old 401k rollover, and you want to convert $10,000 of after-tax money to Roth. The IRS doesn't let you just convert the after-tax money. They say, sorry, your $10,000 conversion has to come proportionally from all your IRA money. So if you have $100,000 total, $90,000 pre-tax, and $10,000 after-tax, only 10% of your conversion is tax-free. The other 90%? Taxable. You just turned a tax-free conversion into a tax nightmare. This is why the Pro-Rata Rule is the single biggest mistake people make with the Mega Backdoor Roth. But here's the twist, and this is the part most financial advisors don't tell you. There's a way to completely bypass the Pro-Rata Rule. You roll your traditional IRA into your 401k before you do your Mega Backdoor Roth conversion. Think about that for a second. Your 401k is not counted in the Pro-Rata Rule. Only IRAs are. So if you move all your pre-tax IRA money into your 401k, your IRA balance is 0. And if your IRA balance is 0, the Pro-Rata Rule doesn't apply. Your entire Mega Backdoor Roth conversion becomes completely tax-free. This is the cheat code within the cheat code, but you have to do it in the right order. Step 1. Roll your traditional IRA into your 401k. Step 2. Make your after-tax 401k contributions. Step 3. Convert those after-tax contributions to Roth. Step 4. Enjoy your tax-free Roth money. If you do it in the wrong order, converting before rolling over your IRA, you're going to get hit with a massive tax bill, and the IRS will not be forgiving. All right, let's wrap this up with a clear action plan. Here's exactly what you need to do if you want to use the Mega Backdoor Roth in 2026. Step 1. Check if your 401k plan allows after-tax contributions and in-service Roth conversions. Call your HR department or your 401k provider. Ask those 2 questions. If the answer is no, you can't do this strategy with your current employer. But if you're self-employed, you can open a solo 401k that allows both. Step 2. If you have any traditional IRA, SEP IRA, or simple IRA money, roll it into your 401k first. This clears your IRA balance and avoids the Pro-Rata Rule. Step 3. Max out your regular 401k deferral. That's $24,500 for 2026. Step 4. Calculate your available after-tax space. Take the total limit of $72,000, subtract your employee deferral, $24,500, subtract your employer match. The remaining amount is what you can contribute after tax. Step 5. Contribute that after-tax amount to your 401k. Step 6. Convert those after-tax dollars to Roth immediately. Do this as soon as possible after the contribution hits your account. Why? Because any earnings on those after-tax dollars before conversion are taxable. So convert fast, ideally within a few days. Step 7. Repeat this process every year. Now let me leave you with one final thought. The Mega Backdoor Roth is one of the few remaining legal strategies that lets high earners bypass Roth income limits and shelter massive amounts of money from the IRS. But here's the thing. Congress tried to eliminate this loophole in 2021, and they might try again. So if your plan allows it, do it now. Don't wait, because this loophole might not be around forever. That's it for today. If you found this valuable, drop a comment below. Let me know if your 401k plan allows after-tax contributions. And if you want more videos like this, hit that subscribe button. I'll see you in the next one.